How to get a loan to buy a motel. I'm Paul Maguire. I'm going to show you 4 different ways to get a motel. I've owned several. Here we go. Watch right now. When you go to buy a motel, it may be something that's operational, or it may be something that's boarded up. It may be something you want to convert to an apartment, or it may be an ongoing operation. So depending on the type of motel that you're buying and the condition it's in is going to depend on the financing. So we're going to talk about 4 of them right now. The first one, for an operational motel, you're going to want to look at SBA. SBA, oftentimes you can get in with 10% down. SBA is the Small Business Administration loan, which means they guarantee it, and they have some guidelines that they go through on how to do it. Your banker who does SBA loans will be able to help you through that process. What they're gonna need is the financials from the hotel, what it's been doing for the last few years. They're going to need your financials, a couple years tax returns and financial statement, and they're gonna need some bank records from both the hotel and you to show the deposits and verify the income that's on the financial statement. With that, they will look at the amount of cash flow that the hotel produces or motel produces, do what's called debt service coverage. What does that word mean? It means if I have $1 worth of debt I got to pay every month, how much cash flow or net operating income after expenses do I have in order to make that payment? So let's say it's a $100 payment. You need, say, $110 in net income after your expenses. So you got your gross rents, your expenses, your net income. After your net income, you need at least 1.1 to 1.2 typically debt service coverage. So if your payment is $10,000 times 1.1, you need about $11,000 in extra money after all the expenses to be able to make the mortgage payment, if that makes sense. So SBA is one of the ways you could go. The second way to go for a hotel is commercial financing. Similar to SBA, they're similar. You go to your bank and you say, I want to finance this motel. How am I going to do it? They will have typically require more down, where SBA you may be able to get in with 10% if you have enough debt service coverage, enough income at the end. With a commercial loan, they may require 20, 25, 30% down, 35% down, depending again on 1, the debt service coverage, and 2, the appraisal or the value of the motel. Now, smaller motel, larger motel, doesn't matter. The same, whether it's $1 million loan, a $500,000 loan, a $300,000 loan, or a $5 million loan. The process is the same. Financials, bank statements from you, and financials of the property, and some income certification through either bank statements or deposits from the seller. The other thing they're going to want, of course, is your insurance to make sure that there's been not a lot of claims or problems with the property for the last 5 years. So that's the second way to finance, is to go to a commercial lender. Now, how do you find a commercial lender that specializes or will lend in motels? It's real easy. Google. Just Google it. You'll see a number of people that when you put in, I want to finance a motel or motel financing or hotel financing, they will be people who specialize in that. So like with SBA, you'll have banks that do SBA loans. You'll have other banks that don't. You'll have banks that lend on office buildings. You'll have other banks that don't. They lend on motels. They lend on multifamily. So depending on the appetite for the bank and where they want to place money for their investment is going to depend on what they lend on. So when you're looking for financing for your motel, the second way is to find commercial lenders that will provide financing for motels. The third way to finance a motel, and this is common with like motel that needs work or it's not what's called stabilized. Stabilized means there's consistent cash flow over time. Unstabilized means there's a lot of vacancies, the cash flow is up and down, there isn't a consistency of money coming in from the property. Those are the ones I like because they're either mismanaged, not managed, or not being taken care of well, and those just need to be marketed and renovated, and oftentimes you can get the cash flow up depending on where it is and what kind of market you're in. So the third way to do it is one of the ways that I do it. I'm buying a converted motel now that was turned into an apartment building is hard money or private money, and they're different. Let's explain both. Hard money means that you're going to go out, you're going to get a loan from somebody that charges more interest and a little higher rate, and before you get scared, they're going to give you what's called a bridge loan. Now, a bridge loan means almost like a bridge, right? We're going to go from here over to here. How do we get from a property that isn't producing a lot of income to a property that has stabilized income, brings in 20, 22, 19, 18, 25, 26,000 a month versus brought in 5,000, 7,000, 4,000, 11,000, unstabilized versus stabilized. You get it? So with that type of financing, hard money or private money, which is a bridge loan, you oftentimes will get a loan for a year or two, and then you'll go to refinance with one of the first two options, an SBA or regular commercial financing, which again, as you probably know from studying real estate, as you stabilize the property and you go from, say, producing a lower amount of money inconsistently to a higher amount of money consistently, you do what? You increase the value of the property. And after you get 6, 8, 12 months of operating income that's consistent, you're gonna get typically a higher value than inconsistent. So values are based on two things, right? Mostly. Cash flow, how much net operating income, all the cash after expenses, what's left. That's one way, and that's often referred to as a cap rate. They'll use a cap rate to figure out what it's worth. I've done other videos on cap rates. You can watch those. Or two, they're going to base it not only on cash flow, but comparable sales. What have other motels sold for in and around the area? Okay. And usually we look at that as like a price per unit. So if you got a 30-unit motel, they're trading or selling at around 50,000 a piece. That's about $1.5 million stabilized. Now you may pick up that motel at say 700,000 or 800,000, get a bridge loan, stabilize it, and then sell it. And let me give you an example of how that works. I bought a motel in Orville, California. Was not stabilized. Had deferred maintenance, okay? The guy I bought it from had lived there for many years, and he really was not an operator. He was just taking the little bit of cash that he had no debt on it, and that was how he lived off of that motel. So when I bought it to convert it to longer term housing, right? And I couldn't get anybody to lend on it, so I had to get a hard money loan. And this hard money loan was actually a private money loan, which meant it was Mr. and Mrs. Smith lending money to a broker who had a fund who funded the deal. They lent me a little over 800,000. I had to put 400,000 down. I bought it for around $1.1 million, $1.2 million. Jump forward 2 years later, I sold that building for a little over 2.3 million, right? Got it stabilized, fixed it up, put some money into it, and made, well over $500,000 on the deal after expenses and all that. So that is a private financing deal, and it was also hard money. So they're kind of similar, right? The fourth way is to do seller financing. So let's talk about that. Seller financing usually only works if the seller has no debt, or you could take the property subject to the existing financing, which means you leave the existing financing in place and you put a new loan on top of it for the difference, and the seller gets paid some and the bank gets paid some. So it's almost like a hybrid. The existing bank loan stays in place and the seller of the property has a second or a blanket mortgage that covers that, and you make one or two payments, either one payment to the bank and one payment to the seller, or one payment to the seller and the seller makes the underlying payment to the bank. On that last example, where the seller makes the payment to the bank, make sure you want to get statements every month showing that the seller is making those payments to the bank, because sometimes sellers get the money and don't make the payment to the bank on the first mortgage, and what happens? The first mortgage forecloses, okay? So you want to make sure those payments are getting made. That's seller financing. Now, when I do seller financing for a motel or any other property, rates today are a little higher than they've been. So I would look to do something along the lines of potentially a step-up carry. So what that means is the seller carries the financing, and when the seller carries the financing, say interest rates today are 7%. So I don't want to pay 7% because I got an unstabilized motel. I don't have cash flow coming in, right? And I need to get the cash flow up, and I need capital to get their units churned and to do a little bit of marketing and put some management in place to get these rooms filled, okay? So what do? I don't wanna pay 7% on the note in the beginning, so maybe what I do is I offer 4% year 1, 5% year 2, 6% year 3, and 7% year 4 and 5. So in other words, you could stair step the financing if you get the seller to agree to it, and you say to the seller, say, look, I gotta stabilize this thing. I can't even take out your loan until I got 6 minimum, more likely 12 months of stabilized operating income on the motel. And you know what? They already know that, okay? So in order to sell the motel, especially if it needs work or it's not being operated well or it has rooms that are down or needs deferred maintenance or roofing or windows or new furnishings or whatever, they know this, okay? So more of a distressed motel or a motel that doesn't have stabilized income. Now, for something that does have stabilized income, typically SBA commercial financing, seller carry, all of those work, and private hard money works too. Let's talk about private hard money on a stabilized motel, okay? So say you have a motel and the income is, I'm just gonna use a round number of $10,000 a month, NOI, makes $120,000 a year. Let's say you're buying that property for, $1.2 million, okay? Now, why would I use private money on that? The same reason I would use private money on what I'm buying right now, okay? I would use private money because I can get the deal done quicker. I don't have to put as much down. I pay a little bit more in points and interest, but that's just the cost of money, just like the cost of milk. It costs whatever it costs, but I see an opportunity where I can raise the rents in the motel and get the NOI from 120 to maybe 160, right? How can I do that? Painting, upgrading the motel, putting some new vanities in, redoing some bathrooms, putting some new flooring in, right? Fixing the place up and then marketing it and getting a little more. So you drive by any property in America and you look at the facade, you look at the landscaping and you could see, hey, there's some upside here, right? Other ones you look at, you go, wow, that looks beautiful. So neglect, decay, landscaping, exterior, all that, make parking lot big. Makes a big difference if the parking lot's redone or resealed and restriped to get your upside in value of your motel you're trying to buy. And I think a lot of you watching these videos, you're not really trying to buy a motel that's in perfect condition. You're trying to buy something that has some what's called value add, where you can do the things, the landscaping, the parking lot, the outside of it, some interiors, and get your rents from here to here, which does what? As you get stabilized income here versus stabilized income down here, you're gonna get a higher value. And that is the beauty of real estate. Multifamily, motel, houses. I like those because when you fix them, you can get more money, whether it's fix and flip on a house or fix and hold on a house or a motel where you fix it up and you get more stabilized income at a higher level, you're gonna get what? More value. When you get more value, you can get what? More money, okay? More money in two places. More money in a refi, right? Because you've got the value up. So if they lend you 70% of 2 million, is a lot better than 70% of $1.5 million. And you've got more cash flow. So that's 4 ways to finance motels. I congratulate you on looking at motels. It's a great business. You have both your transients and you also have people that will stay them for several months. And you can also, in some cases, convert those to long-term rentals. And the last thing I'll tell you is I recently bought one in Colorado and I used private money. It was a small deal. It's a 5-bedroom, 3-bath house and 12 units. Found it on LoopNet. You could have found it too. It's in Colorado and it's only about $915,000. The individual was remodeling and doing the motel and converting it to an apartment building. Well, he's got 2 units that he never did, right? So his NOI brings in around $10,000, $11,000 a month gross income, but it's right by the hospital. So I have the opportunity to have traveling nurses. It's near the Bureau of Land Management. There's a lot of federal land nearby. We'll have those people stay there. So it could be short-term rental month to month, or it could be a long-term rental where they stay there 6, 8, 9 months. Now in this particular deal, the individual had 3 units that were rented to an employer for $750 a month, all studios. Why? Because sometimes when his employees come to town, there's not enough hotels, motels, things you're looking at, for people to stay. So I picked it up and I'm using hard money. What I'll do is I'll finish the other 2 units, I'll rent out the house, I'll finish the parking lot, I'll improve the property, I'll improve the cash flow, and then I'll go to a local bank and refinance, take out the hard money in 8 to 12 months, and have a stabilized asset that's putting money in my pocket, hopefully in the same way that your investment will put money in your pocket. While I'm giving these tips, you may want to like or subscribe or even comment sometime down below when you're finished and tell me what you think of the tips and the information. Thank you for your engagement.